Good morning, everyone. Welcome to the market opening bell on Wednesday, November 26th, your 10-minute guide to the stock market. Thanks to the phone call between the Chinese and US presidents, both US and A-share markets rose, lifting sentiment in Hong Kong. The Hang Seng Index opened 232 points higher. At one point surged 352 points to an intraday high of 26,069 and finally closed up 178 points or 0.7% at 25,894. The A-share index rose 78 points or 0.9% to 9,158, while the Hang Seng Tech Index gained 66 points or 1.2% to 5,612. Total market turnover was 231.1 billion Hong Kong dollars. Southbound Stock Connect recorded a net inflow of $11.166 billion into Hong Kong stocks. Among the top buys were Alibaba, totaling 56.16 billion, Kuaishou 5.71 billion, Ganfeng Lithium 2.46 billion, Xiaomi 2.31 billion, China Mobile 1.64 billion, UBTech 1.25 billion, and Local Tech 1.2 billion. Net selling was seen in Sinu, totaling 2.02 billion, and SMIC 1.76 billion. Notably, Southbound funds have bought Alibaba for 9 consecutive days, totaling $23.003 billion. Xiaomi for 3 straight days, totaling $1.983 billion. Kuaishou for 3 days, totaling $1.626 billion, while selling SMIC for 4 consecutive days, totaling $1.409 billion. Technically, the Hang Seng Index remains capped by resistance near 26,050 and failed to hold above 26,000. Close attention is needed on whether it can stay above the 100-day moving average at 25,673. On the mainland, the 3 major A-share indexes opened strongly and climbed further in the morning, though gains narrowed slightly in the afternoon. The Shanghai Composite closed up 33 points or 0.9% at 3,870. The Shenzhen Component Index rose 192 points or 1.5% to 12,777, and the Chinex Index gained 51 points or 1.8% to 2,980. Total turnover in Shanghai and Shenzhen reached 1.8128 trillion yuan. The renminbi central parity rate against the US dollar was raised 21 pips to 7.0826. Alibaba reported results in line with expectations but saw revenue growth without profit growth. For the quarter ended September, revenue reached 247.795 billion, up 5% year over year, and beating the consensus of 245.2 billion yuan. On a comparable basis, excluding divested businesses like Sanat and InTime, revenue grew 15%. Adjusted net profit, however, plunged about 72% year over year to 10.352 billion yuan, missing the expected 13.514 billion yuan. The bright spot was strong AI-related and cloud performance. The Cloud Intelligence Group posted revenue of 39.82 billion yuan, up 34% year over year, driven mainly by public cloud growth, with AI-related products achieving triple-digit growth for the 9th consecutive quarter. The China E-commerce Group recorded revenue of 132.58 billion yuan, up 16%, with customer management revenue up 10% to 78.93 billion yuan, thanks to higher take rates. Instant retail revenue surged 60% to 22.91 billion yuan, fueled by rapid growth in Taobao flash orders. As of late October, around 3,500 Tmall brands had connected their offline stores to the instant retail platform. The International Digital Commerce Group grew revenue 10% to 34.8 billion yuan and turned adjusted EBITDA profitable at 162 million yuan, benefiting from logistics optimization and improved efficiency. The company said it is channeling profits and free cash flow into future growth, so short-term profitability may fluctuate. Capital expenditure on AI and cloud infrastructure over the past 4 quarters totaled around 120 billion yuan. Q3 marked the peak of investment in the flash delivery business, and management expects a significant reduction in spending next quarter as efficiency improves and scale stabilizes. On share repurchases, Alibaba bought back 17 million ordinary shares, equivalent to 2 million ADS, for $253 million in the quarter. As of September end, $19.1 billion remain in the repurchase program, valid until March 2027. Separately, Singapore media report that the country's national AI program is shifting its latest Southeast Asian large language model project from Meta's framework to Alibaba's open-source Qwen architecture. NIO announced its Q3 results ended September, showing remarkable progress in deliveries and profitability. Despite slower overall revenue growth, losses narrowed sharply and gross margin hit a near 3-year high. Total revenue was 21.794 billion yuan, up 16.7% year-over-year and 14.7% quarter-over-quarter. Gross profit rose 50.7% to 3.025 billion yuan, with gross margin expanding 3.2 percentage points to 13.9%. Net loss narrowed to 3.661 billion yuan from 5.142 billion yuan a year earlier. Loss per ADR was 1.51 yuan. On a non-GAAP basis, adjusted loss shrank to 2.76 billion yuan from 4.403 billion yuan last year, with adjusted loss per ADR at 1.14 yuan. NIO founder and chairman William Li said on the earnings call that the company is confident of achieving profitability in Q4 this year, citing strong orders for high-margin models like the all-new ES8 and a large backlog. Although Inflow sales were affected by the phasing out of trade-in subsidies, the impact on overall gross profit remains within expectations. Chow Tai Fook reported interim results for the 6 months ended September. Revenue dipped 1.1% year-over-year to 38.986 billion Hong Kong dollars, while net profit edged up 0.1% to 2.534 billion, or 25.5 Hong Kong cents per share. An interim dividend of 22 Hong Kong cents was declared, up from 20 cents last year, with the payout ratio rising 6.8 points to 85.7%. Gross and operating margins were 30.5% and 17.5% respectively. The group operated 5,814 points of sales as of September end, with a net reduction of 611 in mainland China, but slight additions in Hong Kong, Macau, and other markets. Same-store sales grew 2.6% in mainland China and 4.4% in Hong Kong, Macau. From October 1st to November 18, 2025, retail value jumped 33.9% year-over-year, with mainland China up 35.1%, 86.8% of total, and Hong Kong, Macau up 26.5%. Same-store sales during that period soared 38.8% in mainland China and 18.2% in Hong Kong, Macau. India's official data showed October gold imports soared to $14.7 billion, more than triple the year-ago level, despite high global gold prices from April to September. The surge pushed cumulative imports for the first 7 months of the fiscal year up 21.4%. An official attributed the spike to pent-up demand and festive buying, widening India's October trade deficit to a record $41.7 billion. In the rates market, Fed Fund futures still price in more than 80% odds of a 25 basis point cut next month, up sharply from around 30% the previous day. Reports also emerged that President Trump may nominate his close aide and White House economic advisor Kevin Hassett as the next Fed chair. The U.S. 10-year Treasury yield briefly dipped below 4%, helping U.S. stocks extend gains for a third day. The VIX fell 1.96 points or 9.6% to 18.56. The Dow rose 664 points or 1.4% to 47,112. The S&P 500 added 60 points or 0.9% to 6,765, and the Nasdaq gained 153 points or 0.7% to 23,025. The Nasdaq Golden Dragon China Index rose 27 points or 0.35% to 7,753. Alibaba's US ADR closed down 3.3% from Hong Kong's closing price, equivalent to 152.6 Hong Kong dollars. Alphabet hit a new all-time high, closing up 1.5%. Reports say Meta is considering Google-designed AI chips and may spend billions starting in 2027 to integrate Google's TPU into its data centers, while also planning to rent TPU capacity from Google Cloud as early as next year. This intensified competition with Nvidia, whose share fell as much as 5% intraday and closed down 2.5%, the only Magnificent Seven stock in the red. AMD also dropped over 4%. Nvidia defended itself, saying its technology remains a generation ahead and that it welcomes Google's success while continuing to support them. Apple held steady. Counterpoint Research forecasts iPhone shipments to grow 10% this year versus Samsung's 4.6%, pushing Apple's global smartphone market share to 19.4%, its first time at number one since 2011. Economic data pointed to softening growth and employment. U.S. September retail sales rose just 0.2% month-over-month, the smallest gain in 4 months and below the expected 0.4%. The Conference Board's Consumer Confidence Index preliminary reading for November fell to 88.7 from 95.5, the lowest since April. ADP data show U.S. private sector layoffs averaged 13,500 per week in the 4 weeks to November 8th, a sharp increase from the prior period's 2,500. Meanwhile, inflation eased likely. September PPI rose 0.3% month-over-month as expected, with core PPI year-over-year at 2.6%, the mildest in nearly 15 months. That's all for today. A quick reminder. Phillips Securities offers bond trading commission as low as 0.1% of transaction value, with no charges for interest collection or redemption at maturity. Existing Phillips clients must first register as professional investors to trade bonds, except U.S. Treasuries and Hong Kong government bonds. Our stock pick today is Time Interconnect Technology, stock code 1729. Time Interconnect Technology is primarily engaged in the manufacturing and sale of wire and cable assembly products, server products, network cables, and specialty cables. The ongoing AI boom continues to drive strong growth in the group's server business and cable assembly business for data centers. For the first half of this year, revenue from the server segment and the data center segment surged 318.1% and 66.8% respectively year-on-year, propelling overall group revenue up 82.1% to 4.853 billion Hong Kong dollars. Operating profit reached $412 million, a rise of 32.1%. However, the operating margin declined from 11.7% to 8.5%, mainly due to the much faster growth of the lower margin server segment. The group has also placed greater focus and resources on its medical cable business, continuing to expand its medical equipment customer base and enhance R&D capabilities. Following investments in 2 medical and healthcare related companies last year, the group successfully invested in another UK headquarter startup in April this year. This startup develops wearable mechanical devices that combine textiles, copper wiring, and AI technology. Its non-inclusive wearable products strengthen muscles, promote bone healing, and monitor body movements in real time, intervening promptly when a fall risk is detected to prevent the wearer from falling. The group believes this investment aligns with its current investment policy and will generate meaningful synergies, including leveraging the group's upstream copper procurement capabilities, as well as the production and automation strengths of its parent, Luxshare Precision. This will help the group broaden the product portfolio offered to existing major customers and enter new business segments, thereby achieving greater diversification. In August this year, the group announced the acquisition of the entire equity interest in Takjin Chang Investment, a copper cable product manufacturer, for 460 million Hong Kong dollars. Takjin Chang is mainly engaged in the manufacturing and sale of copper cable products, widely used in precision electronic equipment, home appliances, computers, telecommunications equipment, automobiles, medical devices, aerospace equipment, and solar energy products. Its major customers are primarily listed companies and well-known manufacturers in the precision intelligent manufacturing, consumer electronics, and photovoltaic sectors. The company operates across China and the Asia-Pacific region and owns 3 production facilities in Huizhou, Nantong, and Thailand, plus 3 leased facilities in Nantong, Xi'an, and Vietnam, with a total gross floor area of approximately 176,000 square meters. Its established Southeast Asian footprint will enable the group to reduce reliance on copper cable supply from any single country. Recommendation: buy at $15.7, initial target $17, secondary target $17.8, stop loss $14.9. I do not hold the above stock.